Hello, welcome to Trading Central August Technical Outlook. I'm Remy Gossens, Head of Technical Analysis, and with our analyst team, over the next 15 minutes, we are going to review a one-month technical scenario on key assets. Connected with us, we have Gary Christie from North American Research, based in Ottawa, Canada. Hello, Gary.
Hello, everyone.
We also have Nicolas Suiffet, Head of European Research, based in Paris, France. Hello, Nicolas.
Hello, everyone.
We also have Christophe Chevalier, our Forex specialist, based in Paris also. Hello, Christophe.
Hello, everyone.
With them, we will detail a one-month scenario on key assets. Summer is almost over, and with 4 months left to go in the year, we have US indices definitely on the upside and gaining further ground with the Nasdaq up more than 10% since the beginning of the year, while we have on the opposite major European and Asian indices almost all in the red. On the same page, we also have precious metals, cable, and euro against USD, which is definitely trading at a one-year low. And so that's a global situation that is currently very interesting. And in Italy, we also have a very interesting pattern that has just been validated, which is a bearish continuation pattern that we will review this with Nicolas. Now let's start with the US equity market with Gary from North American Research. Gary.
Thank you very much, Remy, and hello, everyone. Lots of changes going on in the S&P overall the last short little while. Let me just get my screen up and running for you. All right. So S&P is up this morning. We're trying to make a recovery. But right now, we are trying to keep above 2690. And now you should see my chart on the screen. And this is a weekly chart of the S&P 500. And what we're looking at, 2690 stop loss, as we've been supported by a rising trend line in place since 2016. And most recently, we've been trying to test this 2690 level a couple times here back since this year. So we do have a short-term overlap area, which we'll go over on a daily chart. But for right now, we expect further upside towards 2872, which is the record high we had back in January, and then 2940, and then continuation on the longer-term uptrend. But I want to bring it into the daily chart. It's a little bit easier to understand what's happening in short term. So here we go. What we have right now is a major overlap in the 2795 area. So we see we tested it back in March, and we tested this level in June as resistance, and we've broken above it in July, and we've tested it multiple times as support, and we were just about testing it yesterday. So we are making a recovery right now in the short term. So as long as we stay above the 2795 area, I suspect we'll continue this higher overall uptrend towards 2872, which again is that record high, same target we have on the weekly chart back in January, and on towards 2910 and 2940, which corresponds to our weekly price levels. So we can see the trend is intact, nice, still a rising 200-day moving average here in green. We're above that 50-day, which is usually a short-term signal. If we break below it, it's a cause of concern. But right now, we are nice to see a nice break above that 20-day moving average this morning. And we should just chug on higher here towards 2872. I do want to share the NASDAQ chart, as Remy did mention that just a moment ago, of how we're still above 10% for the year, roughly 12% on the year actually right now, so today's moves. And look at this chart, it's quite unique, quite interesting, a nice orderly bullish trend channel. We are supported by that blue line, which is that 50-day moving average. And as long as we remain above that 7217 area, that was support here back in July, we suspect we'll touch that upper end resistance area of this bullish trend channel around 7730. But the NASDAQ is the outperformer of the year, and we see some money coming back into some tech names after earnings season has just cleared. So always looking good on the NASDAQ side as our preferred index, and we are just riding higher towards that upper end of that bullish trend channel. Nice to see the RSI above that 50 level. So it just shows us that uptrend is still intact. We've had a lot of volatility with a lot of trade disputes with China and around the world in the US, but it seems to be not as big of a deal in the markets. We see some short-term swings, but overall, we're still in line and we're outperforming the rest of the world, as you'll see with the rest of the team discussing that today on how European markets are doing. Quite the opposite. But that's it for the US side. I'll hand it over to Nicholas with an update on Europe for us. Nicholas.
Thank you, Gary. Let's have a look at the European markets now. And today, we would like to draw your attention on the technical picture on the Italian index, the FTSE MIB index. Let's show you my screen. So why the Italian index? Because the index price has just validated a continuation trend pattern, a bearish continuation trend pattern on a short-term basis. But let's start with a monthly charts to keep the big picture in mind. So you can see on my screen the long-term view on the FTSE MIB index. You can see the huge bearish acceleration between 2007 here and 2009, and then you can see the trading range, the long-term trading range between 2009 and today, between 12,300 and 24,600, and we can notice that prices struck against the upper end of this trading range, this long-term trading range, so around 24,600 in May, so 3 months ago. Since then, the price index has entered into a consolidation phase, and so that's why we think that the continuation of this consolidation phase within the large trading range is likely in the coming weeks. Let's zoom in a little bit on a weekly chart so we can see what just happened. We can identify an interesting reversal downtrend pattern in broadening wedge. You can see here the pattern, the broadening wedge pattern, which is a bearish event thanks to the validation of the pattern here. It happened just yesterday. So a confirmation would be a better signal at the end of this week if the price index can close this week below the lower end of the pattern, so around 20,700. It would confirm the bearish event thanks to the validation of this broadening wedge pattern. In addition, we can also notice that we have seen a bearish cross, so a bearish event between the 20-week and 50-week moving average here. We can notice that it happened in the past in 2016, just here, and we can also see the bullish cross which happened in at the end of 2016, which was the starting point of the bullish trend. So that's another warning signal, another bearish event on the Italian index. Let's zoom in a little bit to see the daily charts or the short-term view, and this is the bearish pattern, the bearish continuation pattern I was talking about. So this is a triangle pattern, and we can notice that validation of the pattern here was so the price index validated the pattern thanks to this bearish gap, so this bearish breakaway gap just below the pattern, the lower end of the pattern. So that's a bearish, clearly a bearish event on the Italian index. So definitely, as long as pricings remain below this gap, this bearish gap, which is set around 21,634. So this is the blue line, as you can see here. As long as prices remain below this mark, a further decline is expected towards the measured down move target of the pattern, which is set around 19,747. So this is the first bearish target on the Italian index, which is set here on the red line, as you can see here. We can also notice that the daily RSI is capped by a declining trend line and is not clearly oversold, sorry. So it means that there is still downward potential, according to us, thanks to the validation of this continuation trend pattern on a short-term basis. So to sum up, on a short-term basis, we are bearish on the Italian index, the FTSE MIB index, as long as prices remain below 21,634. We expect a further decline towards the minimum target set at 19,747, which is the measured down move target of the pattern. That's it for Europe. Let's switch to the Forex market now with Christophe.
So let's start the Forex analysis with euro-dollar, which remains strongly bearish. As you can see, the pair has validated continuation triangle pattern, you can see here. So it was validated at the beginning of August. The pair then posted a slight pullback on its declining 50 days moving average, you can see here in blue, before facing a huge drop at the beginning of August. So we remain bearish below the horizontal resistance at 116.40, which is the 50 period moving average, and also the lower boundary of the triangle. Targets to the downside are set at 111 at first, which is a strong horizontal support, and then 108.70, which is as well horizontal support and previous overlap. If we break above 116.40, a rebound will be likely towards the upper boundary of the triangle at 118.50. You can see here. On the British pound versus US dollar, we are also bearish. We can see that the pair has broken below the lower boundary of declining channel in place since last May. You can also see that the 50 days moving average is on the downside. So we have set our stop loss at this level around 131, around the 50 period moving average. With targets to the downside set at first at 125.90, which is a strong horizontal support and overlap. You can see here in June of last year, and hit as a resistance in March and February. If we break below 125.90, further weakness will be likely toward 123.50 and 121.10, which are horizontal supports and as well March bottom of 2017. If we break above 141 and above the 50 days moving average, a rebound will be likely towards 133 and 134.50 in extension, a very strong horizontal resistance and previous overlap. On US dollar versus Japanese yen, we can see that the pair has broken below a rising trend line placed since April. It has broken below its 50 days moving average here in blue. So further weakness is expected towards August bottom at 110.10, and then 109.20 and 108.10 in extension. 108.10, which is a strong horizontal support and overlap, and May bottom. You can see here what's it as well in February. Became a resistance in February and hit this resistance before facing a huge drop. So following the polarity principle, this threshold behaves as a support now. We will turn bullish on a short-term basis only if we break above July the 31 top at 112.15 with first alternative target set at July top at 113.15. That is all on Forex. Let's switch to commodities.
Thank you, Christophe. Let's start with the current situation on crude oil. Well, we have an interesting development here. We have on the monthly chart that we have here on the screen, you can see that there is a reverse head and shoulder that has been validated. The theoretical target of this pattern is not done yet because it stands around $80.5, which is also 60.8% retracement of the decline from 2011 to 2016. So the current this pattern is still ongoing. And we see a major support around 60.5, which is a previous top from 2015. So as long as this level is support, we can definitely expect a continuation of the rebound, especially because we have seen a bullish crossover between the 20 months and 50 months moving averages, which is a very strong long-term signal. So on the medium to long term, we still expect a further rise toward the $80.5 on crude oil. However, on a daily basis, the situation is quite different because we have seen some bearish pressure taking place on crude oil with the downside breakout of this rising trend line that was in place since November. That happened just yesterday. And we also have some kind of very short-term declining trend line in place since July. And so below 69, we can expect further weakness and a downside breakout of the $64.2 area would definitely trigger a bearish acceleration toward 60.5, which is a very strong medium-term support. If you look at what has been happening in the past, that's definitely 2015 top. So due to the polarity principle, this former resistance is now acting as a support and could definitely trigger some bullish position around this area. So further decline expected below 69, but limited downside potential due to the $60.5 very strong support area. Let's switch to precious metals with the current situation on gold. Well, we can see that we have a huge decline that is in place if we have a look at a weekly chart. However, if we look at technical indicators, they are sharply oversold in a way that they have never been in the past years. So it's definitely a warning signal, and it's a risky market. However, if we look at the daily technical configuration, we can notice a very interesting technical signal, such as the fact that we have the 20-day moving average declining, that is actively capping prices since June. So it's definitely a very interesting kind of trailing stop to protect bearish position, with next down target set at 1,145 and 1,120. We also have this nice declining trend line in place on the RSI, so that's two key resistances that are active on gold prices and adding some downside pressure, and they can definitely help in managing bearish position. So we have a huge trailing stop both on this declining moving average, the 20-day, and on this declining trend line on the RSI. Thank you for watching this video. I would like to remind you our current view on the asset we have been covering during this video. So we are still expecting further advance on US indices. However, on the opposite, we definitely expect further weakness on the Italian index, the FTSE MIB, which has validated a bearish continuation pattern. We also expect further weakness on euro against US dollar and GBP against US dollar, and also on USD against Japanese yen. Limited downside potential is in the card on crude oil with a $60.5 area as target, and we look for further weakness on precious metals, even if weekly technical indicators are sharply oversold. But the current trend can be actively managed by the key resistances in place that have been discussed during this video. Thank you very much for watching this video. We will do another one in early September with an update for the rest of the year. Thank you very much.
Thank you, everybody.